Thank you. I hope everyone can hear me. I'm very happy to moderate this panel today. My name is David Toledano, and we're going to answer a very important question today. Does size matter? And by doing so, we're going to inquire about several things, like what is small? How do you define it? Why is it interesting? What to look for when you look for when you're looking at small deals, small buyouts, and what are the specific risks and what are the opportunities, of course. And of course, as strategy consultant doing due diligence on mid, small, etc., we are keenly aware that you need to be very thorough in assessing small buyouts. Not only because the risk, the scale is not large enough yet, so you can be sure of what you invest in, but also because the opportunities are large and you want to make sure that you explore them all. So I'm going to start with a very simple question. Please let us know who you are, and let us know who you are, and why is small interesting, and of course, how you define it.
Thank you, David. So my name is Marc DER KINDEREN. I'm a partner at 747 Capital in New York. We are largely a fund of funds, although we also spend significant time and resources on making co-investments with our managers. And we only focus on what we define as the lower end of the middle market in the United States and Canada. As a firm, we manage about 900 million, and for GPs, they should look at us as an LP writing about $15 million LP checks. We invest in emerging managers, first-time funds, not first-time teams like most of the folks, most LPs don't, or at least they say they don't. What do we define as small? So first of all, as a fund of funds, we have to look at the size of the fund. So we look at private equity funds that raise capital below $350 million US dollars. Those groups should focus on buying companies or investing in companies. Most of what we do is buyouts. So acquiring companies that are, from an enterprise value, below 100 million for sure, but more than likely below 50 million. And so that also translates as companies that have revenues approximately of 50 million, EBITDA of about 6-7 million. And we love that space because we believe that, number one, you can buy correctly, meaning that you don't have to pay too much for these businesses. There's also reasons for that, risk. We can address that a little bit later. You can create value, and ultimately, hopefully, you can sell them at more attractive multiples at the end of your investment process. So that's what we do. Thank you.
My name is Michal GLADYS. I work for PFR Ventures. We're part of the Polish Development Fund. It's very much like BPI of France or KfW in Germany. And we model a lot of our activities after those institutions. I specifically work in our private equity department. I manage a portfolio of 14 fund investments, buyout, growth, and private credit. And when it comes to small, I think for us, it's probably the smallest, of this group of people. Funds that are sub 100 million, investments that it might be, 5 million EV. And as the development institution, we're interested in seeding fund managers, so first-time teams. We're interested in developing the market and ecosystem, but we also think that that's where the greatest opportunities lie. Thank you.
Good evening, everyone. My name is Jean-François Le Ruyet. I'm a partner with Quilvest Capital Partners. Quilvest is an investor in private equity, or has been an investor in private equity for the last 50 years, which sort of makes us one of the pioneers in the asset class. I'm representing the funds and co-investment team here. We are managing $4 billion in this strategy. We focus on what we call small and mid-market. Our definition would be funds of size 200 million to 2 billion US or euros. We invest globally, US, Europe, and Asia. I would say that, for us, a fund investing in small companies, probably a fund of less than $500 million or euros, so slightly bigger than your definition of small. Why do we like small? I think two main reasons. There is a vast number of companies which are small in all these geographies that are very interesting for the PE industry, number one. And number two, we believe that when you buy a small company, you can buy it at a valuation which is attractive and can transform it and institutionalize that company. So this is it.
Okay, and I'm Jan Clausen. I'm an investment director at COE Partners. We are a GP, deal-by-deal, private equity and growth equity investor in the DACH region. We are one of the pioneers of deal-by-deal private equity investing in Germany and have been around for 20 years now. We're generalists and we currently invest between 20 and 30 million euros per ticket when we make deals across sectors. We've been doing this for 20 years quite successfully. And we define small as one, small cap LBOs, so somewhere up to 100 million euros EV, and two, growth equity investments, so very late stage venture capital type investments in technology companies that are already profitable or just approaching profitability. And we find this attractive because one, there's like a huge amount of companies looking for capital now, and that's actually increasing. I'll explain that a little bit later. And two, in terms of value creation, we usually look for companies that have a huge scaling opportunity, where perhaps we can use a value creation toolkit that's already quite widely used by larger cap funds. You know, the KKRs of this world have their capstones. That isn't as prevalent in the small cap world, and we try to implement that, and that usually leads to quite good outcomes.
When you think small, you think, of course, of many value creation levers that you have, but you also know that you invest in a company that is not at scale yet. So you have to make sure that the management you invest in is able to action the value creation levers that you will define with them. How do you detect the right opportunities, and how do you assess the management skills to implement them? Maybe.
Yeah, I mean, you're looking for proof of the ability of somebody in management to scale. So if the organization has grown for quite a while now, but it's still the CEO basically calling all the shots, that's usually quite a bad sign. So if we see a kind of second layer, you know, proof of delegation, I think that's something that is very important for us.
Yeah, it's you know, Jean-François said it very well, you know, transforming, right? So we invest in managers, first of all, in funds, right? So we actually don't go in and evaluate the management team and improve the management team as a fund of funds. But we pick managers who then ultimately do this. So we obviously follow them closely. And when we make co-investments, we really focus on it. And that's where a lot of value gets created, right? Many times, it's a founder who's run a company for 20, 30 years, who has not invested in a great CFO, because a great CFO is expensive, right? And why do we just have a bookkeeper, right? A lot cheaper. And so one of the transformation tools is to actually augment that management team and to improve it. And so what's maybe interesting to see is that many of the companies that we invest in through our managers and directly, we see EBITDA profitability actually decrease in the first year, 18 months, as the management team gets upscaled. Sometimes replaced, sometimes just added, systems gets put in, but it's a great part of the value creation model is to indeed, you know, improve and augment the management team. It's very important.
To an extent, for us, you know, things are very simple. When you look at the small companies, it's private equity 101. When you really, you know, it's a template, right? And typically, you need to professionalize the company, hire the CEO that's capable of, you know, managing it through his employees, professionalize the accounting, and maybe help with the sales force. but from the manager standpoint, when we look for the managers, we want them to really get their hands dirty, right? Be on the ground, willing to go to places that are far away from, financial center in Poland, so it's Warsaw, and able to find employees that are capable of really professionalizing the firm. But once you have that set up, opportunities are vast, and ability to actually create value is tremendous. It's way different from a mega buyout firm where you're looking at some 2 times value maybe, at best, and something that's very indexed, that's highly priced. In here, no auctions, very proprietary, very relationship driven, lots of opportunities to exit. And it's more, to me, it's more about the opportunity and ability to find the manager that actually have some track record, because that's not easy to find in Poland.
We live in times of crisis. This is the title of this panel today. And of course, we've experienced a few years that were all very different, but all very challenging for many different reasons, and especially for small businesses. How did you navigate those past few years, and how do you plan to navigate the years coming ahead with COVID, no Ukraine, rising interest rates, etc. How do you navigate those times?
I think for us, the way we see it is that actually in the small end of the market, there is probably in the year to come or in the years to come, probably more opportunities than probably in the larger end of the market. Reason being is that in the larger end of the market, the deals are more dependent on the debt, which is arguably today more difficult to arrange. Also, we believe that there will be potentially more deal flow coming from that lower end of the market with a number of founders or managers of these companies who are actually actively looking for some help coming from the private equity GP. So we expect that part of the market to be, at least in 2023, more active than the larger end of the market. This is why very important for us to be positioned in the mid and small market.
Same actually in Germany. So beyond the current crisis, there's really a strategic shift in demand for private equity. So one is successions. So the statistic that we know and usually quote in conversations like this one is in the next 5 years, there's going to be 200,000 companies being handed over by company owners retiring. And we estimate like 10,000 are relevant for us. That's going to be enough for the next 5 years for us. And number one. And number two, the venture capital ecosystem in Germany, as I'm sure you're aware, Berlin, Munich, also other companies catching up, is so mature now that this has created such a huge universe for us in terms of companies to pick from. And then when we pick companies, like we've always done through the cycle, we try to look for the winners, basically, no matter what the economic circumstance is. So if you have superior customer value, and we see there's a bunch of levers that still haven't been used to actually make the company larger, that's usually quite a nice sign. In terms of companies we like right now, honestly we shift a bit more towards acyclical or anti-cyclical companies, which certainly there are a lot of. And also finally, perhaps we've learned that in the small cap space, you might know there's a broad spectrum of managerial skill sets, and we see that companies in private equity hands are perhaps better able to navigate crisis, perhaps respond more quicker to how you need to adjust the portfolio, renegotiate customer contracts and so on, and that actually perhaps creates the opportunity to absorb other companies that are suffering / are exiting the market. So if you look closely, there's actually, I think, quite a lot of opportunities right now.
Small is beautiful.
And what are the specific risks that you have to assess before investing in small? Of course, you could be more dependent on a short customer base. There are many things that could be more risky. What are you, especially in those times, what are you really paying attention to?
Operational risks that's you have to accept. If you invest in small companies, you have customer concentration, supplier concentration. There's an entire sales team of 3 people. What if one leaves? Oops. So there are definitely operational challenges. We believe, and we've seen this over the last 20 years, that smaller businesses that have significantly less debt, also because they can't get it, right? Because they have these operational risks, the banks recognize this, are more nimble when things do go wrong. You have a little bit more flexibility, you have more nimbleness to move things around. And we strongly believe that a lot of these managers of companies have learned through COVID to become more flexible. We were scared out of our minds when COVID hit. We make these risk assessments in our portfolio and everything looked red. The first 2 months, it was a total disaster. And then all of our managers learned, the government in the United States also helped a lot, by the way, so we'll take those subsidies. But the managers also learned how to really quickly react and to switch things, like, if the factory had to be adjusted or shut down for a little bit, how to move the workforce around. The flexibility of smaller businesses to react to situations, the nimbleness of the operational structure, I think is a strong strength. Now, if you do lose, a big customer, you could still have your challenges, and we will see some of our companies have a problem in that phase. But we think the vast majority of them are going to do just fine.
I actually think that, agree completely with what Marc said about the operational side. I mean, that's crucial. But from my perspective, it's also, every time risk also should equal some value or some return opportunity. And for me, it's, I add value by finding the managers that are capable to do that. So if I do my work well, I'm going to uncover a lot of value. I'm going to add a lot of it. And that's way different from, again, from the large or mega buyouts where, I don't risk much by investing with them because they're going to do sort of their job. And I think that's also the beauty of the small. The other one is you can be way more focused, or you can find a niche, a very targeted area where you add value as a manager, but also I add value by choosing specific managers. So, I think that's an important piece too.
I think maybe a word of caution on all that. One level above, I think the data year in, year out, performance data of the funds has shown that in the mid and small part of the market, the difference of performance, the standard deviation, to use a mathematical word, between the different funds and different GPs is quite larger than in the larger end of the market. So this is very important for us as fund selectors to really make sure that we understand what the GP, when I say manager, I mean the GP, what's sort of the secret sauce of this GP in selecting the right companies, the right targets, and the right management teams for these companies. So word of caution there, deep dive due diligence is really needed to select the best teams in order to do that.
And you have a perspective on this?
Well, yes. I hope after all these years of selecting small cap managers. Having companies that on average have, let's say, 50 employees, and so, like I just said, the sales team, consists of 3 people. We believe that the GP needs to be operationally strong themselves, right? The fund manager needs to know if something goes wrong or someone falls away, that they can step in themselves and not get the very expensive consultants to come in at very high, hourly rates in terms of like trying to fix it, but really go in themselves and help the company go through a difficult time. In our view, especially in the United States, which obviously is a very large but uniform market where you can invest, a GP can be based in San Francisco, and easily invest in Texas or in Boston or somewhere else. You need to be specialized in a sector. You know, for instance, in food and beverage, right? So that if something happens with your company and it loses a distribution channel, that you can move in and physically yourself, not just give guidance and talk strategy and philosophically address the problem, but really get on a plane, go to the grocery store chain that just kicked you out and negotiate a new contract. Make it happen. Be involved, add operational value. And we believe that in the United States, that means that you have to be, in most cases, very specifically sector focused. That may be a bit different in Europe. I don't know, my colleagues over here, maybe it's more per country or whatever it may be, but in the US, having a sector focus is crucial.
Well, Marc, Europe is changing. It used to be the case that, especially in the mid-market, it was important to be country-focused, country-specific. Less and less so. We tend today to prefer people or managers, GPs, who have a very precise playbook and are able to repeat that pattern and help those companies grow and transform themselves and institutionalize. So yeah, sector specialists, angle specialists are emerging in Europe across countries on a pan-European level. And yeah, I would believe that country-specific funds are slightly less relevant today than they used to be probably 10 years ago.
The repeatability, I think that's a very good word. You know,
and it's probably especially true in software.
It is indeed, which happens to be my specialty, even though we are journalists. So I agree with you. I think the more mature private equity gets in a certain country, and also perhaps the larger the funds get, you get more specialization. So we have that in our firm, actually. There's like sweet spots for everyone and not so sweet spots for others. Yeah.
I think it's important to remember that in a small space, you can also be, again, more nimble, but play on some themes. CEE countries, and Poland specifically, for many years, quite a few managers were successful on this theme of convergence with the EU, right? Today, when I think about it, I mean, the situation east of our borders is dramatic, and we hope that it will end soon. But when it does, you know, Poland is the nearest country. Most of the rebuild efforts will go through Poland, most likely. So when you think about investing today and your exit somewhere 5-6 years down the road, you know, I think it's a great buying opportunity because a lot of capital will flow through Poland. A lot of capital will flow through the smaller companies that will participate in it. So again, the small allows you to be more thematic, have an idea, investment thesis, and really play on that thesis.
Do you see any, let's say, German funds buying into the Polish markets?
I just try to arrange that, like outside. We're trying to do a deal together.
Oh, is that right? Okay.
We talked about it.
But it does happen? I mean, or do you have to speak Polish? Do you have to be able to read it?
Typically, the way, you know, again, we think about that small spaces, those companies are going to be ready as potentially a manufacturer for a larger pan-European firm, or perhaps a logistics center, or a distribution, or maybe an R&D, because it's still a relatively low-cost opportunity, right? So it might not be a platform investment for the larger PE firm, or even for some strategic, crucial asset, but it will be sort of an expansion or perhaps a basis. And again, with the rebuild efforts, the same principle applies, right? It's just sort of an entry point to the country that hopefully will help with the efforts.
We have a few minutes left. Maybe, are there any interesting stories that you would like to share about specific companies that, small companies that have proven to be very successful and that you have pushed to the next level?
Who wants to start? Who wants to start? So in the US, right, so we have many stories of great companies, we also have stories, by the way, that it didn't work out at all because there is volatility, yes. A lot of what our firms are trying to do is to really grow a company nationally. You know, a lot of the times, for instance, there was this company based in California making organic chicken sausage. And Idell's is the name of it. It's absolutely great sausage, by the way. And so the owner, Mr. Idell, grew the company and had great distribution within the Californian markets. And then he partnered up with one of our private equity firms called Encore Consumer Capital, also in San Francisco, to take them national. And within 3 years, this company had distribution in all 50 states in America, and was able to sell it to a very large strategic at a significant multiple because they needed growth, right? So if you can create growth and an exciting story, there are enough strategics out there like Nestle who want to buy companies like that need a growth story because their own story is rather boring.
My story is sort of sometimes it's good to be lucky, you know, not necessarily smart. But there was a portfolio company of one of the managers we were looking at, cosmetics packaging, a very small series, and so you know, it actually throughout the COVID and situation with Russia, they used to export most of their production to Russian, Soviet Union countries, so that all dropped. But at the same time, a lot of Western Europe companies needed their suppliers to come from closer, the insourcing theme, right? And so whatever was dropped by the East customers was picked up with an extra on the West side. So it's really sometimes good to be lucky.
I think I would take for Corvus Capital Partners maybe the example of one of our direct transactions, not through a co-investment. The company is called Command Alcon. We invested into this company in 2006, 2007. It was interesting because this company is doing software in the ready-mix vertical of the industry out of Birmingham, Alabama. And I think that's where private equity can really add value because we not only added value by institutionalizing this company, which was very much founder-led and had some sort of transitioning issue with the founder, being already in his 70s when we bought in, but also with adding companies to this through acquisition and M&A, and being on the two sides of the pond, meaning the Atlantic, we could help this company sort of in the south of the U.S., relatively remote, doing some acquisitions in Paris, in France, in Canada, in other parts of the world, and grow this company definitely not only through institutionalization, but also through add-on acquisitions. And this is a company that grew tremendously and was eventually sold to another software specialist called Thoma Bravo.
Yeah, we've done this. I think institutionalization, kind of like facilitated by the private equity fund, is something we always do regularly. And I've learned at the first venture capital fund I worked at, eCapital, we had, I think in 2010, we invested in a really small corporate planning, business intelligence software company for SME by the name of Jedox, which basically targeted you have really small companies doing budgeting in Excel. Then you have 3 people involved in the budgeting and the Excel is a mess and you somehow need some software and the big programs are way too expensive. So let's use the small piece here, Jedox, and we invested in that. And then 3 years after the investment, we had Volkswagen in the HQ call us and say, hey, we want to install this now in Brazil. Who can we call after 5 p.m. Freiburg time when the software is down? So there was like, we need to institutionalize this now, like you said. So via hiring somebody really senior from Microsoft who did all the kind of global enterprise readiness, getting all the support structures in place, which is really very easy playbook to implement if you know how a software company is scaled. We're able to kind of develop the company towards investment by Iris, which might be in the room here, and ultimately exit to inside partners, which was really very, very strong exit for us.
Thank you very much. So I think you all agree from what I've heard today that small is beautiful, that there are many opportunities, many value creation levers, but also that you have to be very careful in selecting GPs, in selecting managers to run the companies, and mindful of specific operational risks that you may have, but it's worth the risk.
Definitely.
Absolutely.
Yep.
Thank you.